Now this is concerning. I don't know what to make of this. This is it's interesting. It's going to be interesting going forward, and no one knows what this was. But no one knows how it's going to shake out. So check this out. So it's just minding my own business. You know, being your old buddy Josh. I always check the rates on the 10-year Treasury, and you can see the significant jump up here. So I said, So I looked over the CNBC. I don't care about Tim Scott. Don't care. And we can see that going back to 1980 or so, here's a 10-year rate. So we're still way down here. So this seems like a drop in the bucket. All right. So right now the 10-year is at 3.7. Now, I mean, look, you can see it's huge decline historically. But let's go back to just 3 months ago. Oh, all right. So 3 months ago, we're up here, 3.9. So let's go back to 1 month ago. Look at that. 3.4 to 3.7. That's a 10. That's 3.4, and we get my trusty. I can do it right here. My trusty calculator. If I take my trusty calculator, 3.7 minus 3.4 divided by that's 30 basis points divided by 3.4 divided by 3.4. That's a second, let's do it again. 30 basis, 0.3. I guess I gotta do it like this. Yeah, 0.3 divided by 3.4. That's almost a 10% increase, my friends. 10% increase in the 10-year Treasury yield. In what's that, a week's time or 2 weeks' time, something like that? Since what is this date right here? And 12 days. Huh. And then I said, okay, let's take a look at the 30-year as well. You know, a lot of mortgages and whatnot, long-term debts on the 30. The 10-year is really the proxy. Let's take a look at the 30-year. And look at the 30-year, and that's at 3.964, basically 4%, which is up from 3.54. All right, so again, that's up at 10%. So what's the cause of that? Well, here's M2 money supply. All right, so we're just going back to 1958, M2 money supply. Here's this huge growth. We're going to log this here just a second. Right there. Look at that. Look at that. So let's log this. Format. Log scale left. There we go. Gotta let it settle in for a second. Log or what? Hold on, so I pause it. So here's the difference between the log. I always like to show this because I think people don't quite get it. They say, look at the amount of money we printed in the last 2 years. It's, record. It's a record amount of dollars, but not record amount of percentages. All right, so here's the non-logged. I think it's called arithmetic. I can't remember. Some of you guys smarter than me will know. And it looks like, oh my goodness, look at that. But if we actually log it as a percentage as opposed to the actual dollar amount, the only thing that matters is the percentage. We can see right here. So if we go back to, so you can see, not quite the same level of, oh my goodness, jump out the window. But notice, right there, we got a little bit of a drop off in M2. Right, flatten out during the Republicans when they took over Congress. Right there. So reducing of M2 doesn't happen much. And I'll just go back to non-log because I want to see what it actually says. And so reducing of M2, so we're going to see right here. Let me get rid of this thing real quick. There we go. We're going to have reduction from January 2009, 8.27 trillion. That's not even a reduction I can see. 8.3. Yeah, that doesn't even look like that's not even a reduction right there. I mean, that's flattened, but it's not a reduction. 3.3 trillion, that's not even a reduction. 3.3, so basically from 3.3 in June 1991, we had 3.3 in July of 1992. So they didn't increase M2 at all. And then we went right here, and that looked like a little bit of a decline. 3.48 to 3.479. Not much, dude. And then we had a tiny one like in 1970 or something like that, right there. 587, 589, 586. And we went from here friggin' 21 trillion, 21, what does that say? 21,697 to 2818. 21,697, basically $1 trillion less than M2. We've never seen that before, none of our lives, ever. And so what does that mean? Well, inherently that tells me that the government is reducing their money, which means they're not buying up bonds, and that means they're selling bonds, which is why the yields are going up. So I'm getting crushed in my bonds right now, and I still have a fixed bond. I mean, so if you have a mutual fund, this is where the problem is with mutual funds and ETFs. You don't have a set maturity. You don't have a set maturity. In and of itself, that doesn't bother me that much. But people flip out like, oh my goodness, I need an individual bond so I don't get smoked. Well, what my hold on a second. So I got 50,000 in this. This is my it's a Federal Home Loan Bank. It's callable. It'll be the first time it'll be called is right the first coupon days. So September. I thought it was June. September. Okay, gotcha. And the coupon is 6%. So I'll get paid some money in September, and it can be callable. Then I think it's got the callable. It can be called in June. Okay, it can be called in June. I'm not sure that's going to be called now because the rates have gone up. It might well be. It might well be. But anyway, and it'll be called at par. So I'll get, if I put $50,000 in, I'll get $50,000 out, and I'll still get some kind of a coupon. For the quarter or whatever it is. They got to pay the interest as accrued. It's called accrued interest. So anyway, the interesting look at right now. The yield on this right now is 6.021. The price has actually gone below par, which is 100. All right, so your yield to call is 11.3%. And I frankly, they only got 5,000 available, so I'm not sure how much. I don't know how much it is. Not quite sure. That doesn't make sense to me. Yield to call. I mean, because you're buying it for 99, they're going to call it, and I don't get that, man. That doesn't make sense, man. So I'm not quite sure how they're getting this yield to call. I frankly, it's fine. I don't really care. But if you're buying it at 99 and they call it, they're going to call it at 100, and you're going to get a coupon too. But you're not going to get a full year of coupon if they call it in June. So I'm not sure why they got that, but whatever. But your yield to worst here is 6.081, which I don't get the yield to call. So anyway, I'm fine with that. But that's annualized, and I'm not going. If they call it in June, I'm not going to annualize. So I'm not all that worried about that guy because I was worried because the interest rates are dropping. I'm not all that worried about it now because interest rates are going up. They might call it or not. I don't know. But when I'm going with this is this just the beginning? See, we've all been under the assumption that the federal government can't. I mean, for 15 years now, the federal government cannot allow rates to go up to historical norms. Because then the cost to service the debt would be the number one line item. We've all had that assumption for many, many years. And I'm starting to think, what if we're wrong? What if Jerome Powell's putting a squeeze like they did in 1920, 21? Where Silent Cal said, we're going to let the economy freaking work itself out, but we cannot. We're not going to get involved. Maybe Jerome Powell saying, we're just going to let the economy crush for the next 2 years. I mean crush in a negative way. I don't mean a positive crush. Get crushed, I should say. To wipe out a lot of these zombie companies, these zombie stuff, I don't know. But when you're seeing the yields go that high, that fast, and you're seeing the M2 going that low, that fast, which we've never ever seen before, and you know that they're going to wind down this insane war in Ukraine. We don't have the money to do that. We can't afford to provide the cover for Ukraine's borders while we can't police our own. And an election coming up as well. And the only thing so I don't know, man. All I know is when interest rates starts, there's a spike in rates, dude. That's a 10% increase in rates in literally 12 days. And that's not even 12 trading days. When you see such an increase, your first thing is, when's it going to stop? Is it going to stop at 4, 5? And what does that do for the overall economy there? You see what I'm saying? We already know that the number of houses that are being sold is like historically low. It's crazy. Not a lot of people trading out in real estate. And there's not a lot of people trading out in real estate. What does that mean? There's not a lot of realtors getting paid. How does that affect other people in the economy? And that's just realtors. Not a lot of people doing upgrades too. If the cost to borrow their upgrades is through the roof, even though the price of lumber is way down. A lot of people are going to say, I'm not sure I want to borrow. If they got cash, that's fine. But I'm not sure I want. And then again, you got to think about it. If they got cash, they're happy to get 5% of the CDs. So you're sitting there thinking, okay, so not a lot of transitioning in the real estate market, which is only going to continue if the rates keep going up, especially if you're kind of locked into these low rates, which is great. How many people are locked in the low rates? I'm going to stay here for another 5-10 years because I got such a low rate. Are going to be doing a lot of stuff on their home. They might do some, make their own deck because the price of lumber is low, but are they really going to do a bathroom remodel? Probably not if they don't have the cash because the cost to do this is high now. You see what I'm saying? With the rates going up so much. So, and don't forget, real estate is a huge contingent of our economy. I was reading this book the other day, this article the other day about the wealth creation by securitizing our assets, essentially. And this guy was this economist, I can't remember where he's from. But he's like, yes, this is great because we used to be able to say we have assets and our wealth was based on the value of those assets. But now we securitize them, i.e. make them as a stock, essentially, and we can increase our wealth effect by saying a productive asset that used to trade at 1 or 2 times value now can trade 10, 15, 20 times value, which increases wealth. It only does, and it's a greater fool theory, increases wealth as long as someone's willing to pay that higher value. Anyway, so his argument was we have 2 sources of primary wealth creation in the United States: is real estate and securitizing assets, securitizing productive assets. A farm. Well, you securitize a farm, now you used to get 1 or 2 times revenue. Now you can get 10, 20 on revenue. All right, but again, that's greater fool theory. That works as long as there's a greater fool than you to pay a higher price. And then the securitizing real estate with all these various, collateral, debt obligated, all this stuff. You know what I'm saying? And you're just wondering, are we at the beginning of where real estate isn't the primary drive? And I don't know. I don't know. We're seeing the M2 dropping like we've never seen before. And that keeps happening, i.e. the government getting out of the business of buying bonds. When they're buying bonds, they're creating a demand for the bond, which makes the price go up and makes the yields go down. That's literally what the government does. And I told you before about the Bank of Japan. It's like the premier holder, not just in government debt, but in private companies as well. Publicly traded companies, if that makes sense. And we are the biggest holder of our own debt as well, the United States, by far. What China does is a drop in the bucket compared to our own debt. So if we start saying we're no longer going to support the prices of government debt because we don't have the money to do this. In fact, we're going to sell the bonds by essentially taking the money out of the economy, right? We're saying, give us the money. We're going to sell the bonds. We're no longer buying them. We're selling them. We're taking the money out of the economy. And you can see that M2, and you can see the rates going up. What does that mean for the long term? When I'm saying long term, I'm talking like 1 to 3 years. I have no clue. I'm just seeing that right now. Let's see, my EDV is probably getting destroyed. So I got EDV, which is betting on long-term government bonds, long-term low coupon. I'm sure that's getting destroyed. Yes. Yeah, look at that. It's getting hammered. So I bought this about 3 months ago, and there it is, just there, shoosh, right there. Yeah, so I'm getting absolutely obliterated there. So it was 90, what was that, 93, and now it's at 83. So it's down another 15%, which I'm stunned. I did not expect this to happen. At some point, when the markets level off in terms of interest rates, the bond market is going to take off. I thought for sure it'd be this year because we were down in 2021. Got smoked in 2022. 2021, we're down just a little bit, like 1%, no big deal. 2022, we got smoked like we've never seen. And we're getting smoked again right now in terms of long bonds, which is crazy. I'm stunned by that. I'm not worried about it. It is what it is. And, government guaranteed debt is the safest investment you could possibly make. And that you're still getting rewarded. It's still paying a decent yield. So that doesn't bother me. But I'm surprised how the bond market is getting pummeled again. It's great. And there's long bonds. And, it's even intermediate bonds, too, for that matter. And that's weird to me. And I don't know where it ends. You know what I'm saying? I'm reading all over the place. The world is still mired in high food costs because of high energy costs, and we're going more to electrification of everything. We don't have the ability to provide. Oh, my goodness. It's like we're dealing with idiots. We don't have the ability to provide the source of electricity in which to electrify everything, which means we're going to have scarcity or have rations essentially, and that's not a growing economy. That's a decline, an entropy economy, which is, I think, what they want. They being the bad, evil green people. But anyway, from an investment perspective, I don't know. I'm not changing my thing here. I'm doing what I'm doing. I've still got a third, a third, a third. Third cash, a third bonds, FHLB, and a third stocks. That's my goal. Not quite exactly like that is. I still have more stocks, way more stocks than bonds, but that's the thought process. That covers all bases the best you can. Love your thoughts. Don't forget to sign up to the doobly-doo, the email list. I've been emailing a little bit more recently. Support me on locals. You can see in the doobly-doo down there. I'd love to hear your thoughts. See you.